Life, money, action.
Welcome to Small Change, Big Gains, the podcast where we explore how small, intentional decisions can lead to major results in your financial life and personal growth. Whether you're looking to invest smarter, develop better habits, or simply find balance, we'll learn together how minor shifts can make a big impact. Join us as we unravel experiences, explore practical tips, and hear inspiring stories. Let's make it happen, one small change at a time towards big gains.
Good afternoon, everybody. Welcome to Small Change, Big Gains. That's the name of our podcast now.
That's the name.
It's been a while.
When did that
It's been
change?
for a while.
When did that change?
Yeah,
Like a long time ago.
Oh,
Old news.
Welcome
wow.
to fall, everybody. How's
It's
everybody's
fall.
summer really quickly? How's everybody's summer? What'd you guys do?
We did a lot of swimming. It was a very hot summer, so we were in the lake a lot, which is
Sean?
fun.
I had fun. Lots of fun.
How much fun did you have?
fishing. I did shooting. Clay pigeons, not animals, everybody. But
Was this in Toronto or Key West?
I didn't go shooting in Toronto.
Oh, okay.
No.
I know you like Key West, so I just thought I'd.
No, a friend of mine took me to an island called Griffith Island, which is an island just in and around Wyerton. Shooting, like it's a hunting island, but they do sport shooting and stuff like that. And we had a whole bunch of fun. That was kind of the end of July. That was amazing, and spent a lot of time kind of working from the home office, which is kind of nice in the summer.
Yeah,
and
that's nice.
did a little bit of travel too.
Yeah.
So there you go.
Fun.
Yeah, so
Went
we had a
by
lot of fun.
fast.
Sounds like you guys had a lot of fun, and I hope I'm being sarcastic, or I hope you can tell my sarcasm.
What, you don't want us to have fun? We're not allowed to have fun.
I
We
do.
have to
I'd
be
love for you guys-
boring advisors all the time. We can go and have
I love
fun.
you guys to have fun. It's,
Jeez Louise, man.
Intense.
I don't know. I think, guys, I'm just old before my time.
Yeah. I think
God,
so.
honestly, what a buzzkill you are.
I know. I could be.
All right, well.
Well,
okay,
we're
well,
here.
You know
It's
what? You set
fall.
up nicely for our topic.
Yeah, our topic is a bit of a buzzkill, but
Why? What are we talking about?
we're going to be talking
What do you
a
guys
little
got for
bit
us?
about some of the jobs numbers that have come out. So again, summer tends to be quiet from a market perspective. Things
Mm-hmm.
tend to be, the news feed is less busy. Everybody's kind of away. Trading volumes go down, but we are back. It's September. It's picking up. The headlines are back, and our job numbers came out. And
Promising.
No.
ouch.
So August. So let me put this in perspective.
Yeah.
In August, we announced our job numbers. We lost 60,000 jobs. Okay, and that's on the backdrop. I think we lost in July 25,000 jobs. Inflation is very tepid. Our participation rate in the labor force is declining, which would signal that our labor force is becoming, less motivated. And that job, I felt that when we announced the job report in August, it kind of went through with little fanfare. So I want to equivalize it for our audience, okay? If the United States came out with a similar print in August, that would equate to a loss of 500,000 to 600,000 jobs.
So our losing of 60,000 jobs equates in the U.S. to 500,000 or 600,000.
Between 500,000 and 600,000 jobs.
Oh yeah, because they got 10 times. Is it because
Right.
they got 10 times?
They got
the
10 times the population.
Right.
To put this in perspective, that was the rate of job loss at the height of the financial crisis in 2008. They'd be running around with their hair on fire if they had a job loss like that. In fact, if you think about,
I just moved it back for you.
well, you always told me to talk close to the microphone.
Okay, here.
Oh, God, stop fighting. You're ruining the story.
Anyway,
Go.
my point is, I'll give you an example. Like the U.S. came out in August with a jobs report of 27,000 jobs created. That caused them to run around with their hair on fire. And the
Right.
Fed is likely going to take some action. We're going to get into that in a moment. But the U.S. Fed is likely going to take some action as a result of a tepid jobs report, not a financial crisis jobs report like we have here in Canada.
So why don't we run around with our heads on fire? I don't mean to steal your thunder.
Well, I think that's a question for policymakers. I think we got to start talking less elbows up and more how do we focus on driving the economy forward so we can put our elbows up, because right now
We're laying flat on the
we're
floor.
lying on the ground. We can't. We're punching off.
Yeah.
Lying off our backs right
yeah.
now.
Yeah.
And it, as much as we want to lay blame in certain, at the hands of certain people, yes, but President Trump, I'm looking at you. Really, it's not. Like we got to start looking internally, doing stuff.
Yeah.
So
Yeah.
that said, it got us to thinking. We had a great lunch yesterday with a gentleman by the name of Jack Manley, who's a global strategist for J.P. Morgan, and he was talking about the divergence, if you will, in the last 5 years of the Canadian economic performance and the U.S. economic performance. And he talked about there's several reasons why that is. by the way, spoiler alert, U.S. is doing way better than we are.
Mind you, the U.S. is doing, or at least was doing, way better than the rest of the world as well. Like Europe is not excluded from that list.
I mean, that's true.
Right.
And actually that kind of talks about one of the things he talked about, because he talked about the role of central banks in guiding the economy, right? Like monetary policy. And I think I implicitly knew this, but I never heard it explained as explicitly as Jack explained it, which is how the Fed behaves as it relates to monetary policy versus how the Bank of Canada behaves as it relates to monetary policy.
Right.
The European Union, their central bank, and so forth, Bank of Japan, et cetera. And what did you learn in that conversation, Amy?
Well, I think what was interesting is we know that the Bank of Canada, we always talk about inflation, the 2% target, right? And the reason they focus on the 2% target is so that businesses can know that that is a consistent thing that they can build their business plan around. And so that is always our focus, is inflation. But
it's actually, if I can add, it's more than just a focus. Excuse me. It's actually a mandate. It's legislated.
Mandate.
They have a single mandate.
That is their mandate.
Under legislation, which is to focus on target inflation.
Right. Yeah.
So sorry.
That's Bank of Canada, right?
Yeah.
Bank of Canada.
Okay.
Yeah.
Gotcha. Yeah.
But then Jack started talking about the U.S., and I think we both kind of thought the same thing. Well, that's the equivalent of like the Bank of Canada, the Federal Reserve. They do the same thing. But in fact, they also have a mandate. Yes, inflation is one, but the other is around the jobs.
Dual mandate.
They
can pivot. They can they can focus on either of jobs or inflation or both, and they can pivot depending on the data dependency or the data sets they're seeing.
Right.
So, give you an example. And when I saw the jobs report, the first thing I thought was interest rates for sure are going to come lower.
Right.
In Canada. They have to. There's no reason to have them heightened to the extent they are.
Right.
Well, Jack's point was not so fast.
Right.
Because if our inflation data, even though our jobs numbers are frankly, unless something changes, they're really not that great. They're tanking a little bit. If the inflation data comes in where the Bank of Canada doesn't like certain core metrics in terms of where they land and from the inflation pricing data, they won't reduce rates.
Yeah.
They'll sit on the sideline because their mandate is not to stabilize employment.
So you're saying that although the unemployment numbers may or may not come in high, what they care more about, or their official mandate, is inflation. If inflation numbers come in high, they don't have to cut rates.
They will not cut rates.
Even if they see, for example, 100,000 people now unemployed.
Yep.
If the inflationary numbers come in a little bit higher, they're not cutting
because
rates.
legislatively, they are not allowed to. They can't react to that data.
Right.
Unless they have the cover of somber inflation data.
Okay, so this is all very...
back it up. Sorry.
Okay.
Back it up a step.
Yeah.
Inflation in Canada right now, again, we get our inflation numbers next week. U.S. came out with their inflation numbers today, actually, and it's like, I think U.S. inflation sitting around 2.9%, a little bit higher than expected, blah, 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 blah. Canada might come in around 1.8, 1.9%. Some metrics will be higher than others. Bottom line is inflation in Canada is somewhat lower than U.S., which is stand to reason because our economy is not growing near as fast as the U.S.
Right.
That said, the U.S., the Fed, right now is ready to cut rates very aggressively, even though inflation's a little bit elevated relative to their OECD peers.
Right.
They're prepared to cut rates because the labor market needs stabilizing. They are pivoting. Something the EU central bank can't do, the Bank of Japan can't do, we can't do.
Right.
And that's why part of the
but explain that. So that's the thing. We looked at other countries, and that is the case. They all seem to follow, well, a large majority seem to follow the single mandate of inflation, not like the U.S.
So the European Central Bank, okay, their core mandate, so language is different depending on the legislation of different countries and stuff, but their core mandate is control inflation. Their secondary mandate is market stabilization, labor market stabilization, so on and so forth. But it is clearly secondary to inflation.
Right.
Same with Canada.
Right.
So, okay, so my question is then, if unemployment numbers, for instance, and I'm only challenging here the economist side of your mind, Sean. If unemployment numbers are high, wouldn't that eventually lead to lower inflationary numbers? Less people having jobs, less people having buying power, or less buying power. Shouldn't that bring inflation down?
All things being equal, yes.
In a perfect world, baby.
But there's exogenous shocks potentially going on.
Right. Okay.
Like I'll give you an example. And by the way, the example I'm thinking of, which is economically disaster, which is called stagflation, right? Which is low economic growth, high inflation.
Yeah.
You get exogenous shocks to the economy. So one of those could be we decide to retaliate tariff-wise against the United States, raising prices here in Canada.
Of products coming in.
Right.
Yeah.
That could, result in inflation.
Right.
Yeah.
While unemployment increases.
Right.
Okay, so dual mandate versus single mandate.
Yep.
Looks like the U.S. is the only country that has a dual mandate, or at least from the OECD countries.
Based on what we could tell in the research that we did.
Yeah.
Okay. Now, that's not to suggest that the Bank of Canada cannot react, or the Central Bank of the European Union and so on. They can't react to the employment news. They can if and only if the central inflation numbers are in line with their target.
Right. Okay.
So it means don't expect the Bank of Canada to make a big shift just because of that job number, because it hasn't shown through an inflation.
Or many job numbers like that. They won't do it.
Right.
Okay. So these
But
are
where
all.
you do need to look for where the change will come, we have to look policy. What policies are we going to implement how do we improve this number? Because unemployment rate, to put it in percentage terms, it's unemployment sitting at 7.1% in August.
This is in Canada?
In Canada. But youth unemployment rate, and youth is defined between the ages of 15 and 24, that's sitting at 14.5%.
That's high.
That's really high.
Yeah.
So that's probably a topic for another podcast. Because I don't want to just rip off, what we should be doing and what not doing.
So I just wanted to quickly touch upon, okay, me as the average individual, why would I care about dual mandate versus single mandate? And how does that, what are the implications of what you just taught us here?
So from an investment perspective, there's a lot of reason for Canadians to not want to invest in the United States. Okay, there's a lot, and I won't go into them. We all know what they are.
Yeah, we've spoken about that on previous podcasts.
There's a lot of reason not to invest in the States. But one of the reasons you do want to invest in the United States is because it still remains the most innovative, flexible economy in the world.
Yeah.
And part of that is, now we can debate and like Trump interfering with the Fed and all that stuff, the independence of the Fed, which, by the way, that's just critical to economic success, is Fed independence, in my view.
Yeah.
But the ability for the Fed to dually look at inflation and employment at the same time and market stabilization as part of its broader mandate gives the U.S. the economic flexibility that if things are going wrong in a certain area, they can pivot and take care of it quickly versus all the things we're talking about fall under the domain of fiscal policy, which is government, which doesn't happen quickly.
No, slow.
Very slow.
Very slow.
And frankly, any economist will tell you behind closed doors, and when government spends money, they suck at it.
Yeah.
They most certainly do. Yes.
Okay?
Yes, I agree.
They do.
Yeah.
Versus monetary policy is putting money into the hands of the economy and letting the economy work itself out of whatever it's doing. Okay? Largely. So I think, from your perspective or my perspective, or I'm an investor out there, it's just when you bake it into the overall cake of what is the U.S. economy, it just kind of augurs that you probably don't want to be running away and abandoning your U.S. dollar or your U.S. company investments right now because they do have the levers that they can pull. I mean, Winston Churchill famously said this about the United States, is that the U.S. will always get it right after they exhausted every other possible alternative.
Yeah.
Okay, so words to that effect, right? And that's kind of what it is. So, with Canada, we're a one-trick pony as it relates to monetary policy, which limits our response to economic. I would argue our job market right now is not yet in crisis. I'm emphasizing yet.
Actually, it's funny you say that. So we're going to we'll leave AI out of this. We're going to do another podcast on particularly AI, but I did ask ChatGPT its opinion, and it said the job market in Canada is looking rough right now. It's not, in brackets, yet a full collapse, but many suggest that weakening will maintain for several years.
Sam Altman sounds like he's trying to recruit down south.
Yeah, pretty negative.
I did something similar. I did a ChatGPT search. And, it said this to me. It said, if I had to sum it up, Canada's economy is performing modestly, but it's under stress. It's not booming, but it's not in a free fall. It's more of a caution stage. Resilient in spots, fragile in others. And then it asked me, what are you up to on Wednesday night? Do you want to go for a coffee?
That is so funny.
Yep.
Well, I know the former Bank of Canada governor, I think, came out a few days ago, and said that both the U.S. and Canada seem like they've got some, he emphasized some symptoms of going towards a recession, but I don't know. I'm not an economist, so I can't really speak to that. But in terms of Canada, it is our, being a little just, I guess I want to say complacent or just there. That's always been Canada, though, right? Like we don't really take the risks that the U.S.
Which in some regard, you don't want to run around being crazy.
And mind you, less people, you brought up 08, Sean, sorry, interrupting you.
Yeah.
Less people lost money in Canada than in the U.S., right? We less businesses obviously went out, and obviously because of our highly taxed dollar in Canada compared to, for example, the U.S. Canada did also have the ability to react, and I'm not bashing or the U.S. here. I love U.S. companies, and I think it's your point on innovation is on point. I think the U.S. is for sure, at least in the past 100 years, the most innovative economy in the world, right? But Canada did, for instance, react differently than the U.S. when COVID hit, and the unemployment numbers. Canada did balance that quite well. But yeah, I just thought that
we are a question there.
No question. Oh. It was just a comment about your we are about the Canadian economy, that it's not in free fall. We're not growing, but we're not in free fall. That we're just meh. Right?
Okay.
Yeah.
I mean, okay, as a Canadian, that just warms my heart. I mean, yeah, okay, we're here. Like
we are
definitely
meh.
has its downsides. Yeah, we are meh.
It's like hanging out with your aunt. Like, okay, great. Like, whatever. Right?
Do you want to hang out with the fun uncle?
Good for us. Yeah, we want to hang out with the fun uncle. Yeah.
I want to hang out with that shirtless drunk uncle showing off karate moves at Christmas.
Oh no.
That's what I want to do.
Okay, maybe not to
Coachella
that
sounds fun.
extreme, but yeah.
Anyway, I'll leave it at that. I think just when you're thinking of, when you hear central bank announcements, be mindful of the mandates that they're under, right? And be more mindful of it. And that may give you a little deeper understanding or subtle understanding of why maybe the U.S. is cutting rates at a more aggressive rate than Canada is, even though we may appear to be economically weaker and all those different things.
Yeah.
Okay. Gotcha.
Yeah.
Thanks.
And stay groovy and stay employed, everybody. Get harder out there.
Always. Good luck, everyone.
Till next time.